Hey everyone, today is March 6th, 2026, and we're going to dig into a really interesting new call from Morgan Stanley on NVIDIA. Now, before we jump in, you know the drill. This is just an explainer to break down their report. It is absolutely not financial advice, so please make sure you do your own research.
So let's just cut right to the chase. The big headline is that Morgan Stanley is officially moving NVIDIA back to their #1 top pick spot. After a bit of time on the sidelines, they're back in. The real question, of course, is why now?
So what's the big why here? Well, in a nutshell, it really boils down to a disconnect. For about 6 months now, NVIDIA's stock has basically gone sideways, just flat. But at the same time, the business itself and the earnings estimates have just kept climbing higher and higher. Morgan Stanley looks at that gap and sees what they're calling a surprisingly good entry point for anyone who's willing to look beyond the day-to-day market chatter.
And this right here is the heart of the matter. The reason this stock has been flat is because of one word: skepticism. Investors are just really skeptical. Can this kind of insane growth actually last? So the rest of this breakdown is really about how Morgan Stanley answers that very question. Okay, so the first piece of that skepticism is all about spending on AI. The hyperscalers, your big cloud companies, are shelling out just unbelievable amounts of money on AI chips. And the big question hanging over everything is, can that really continue? Is it a boom or is it a bubble?
And this debate is pretty fascinating. On one side, you've got the bear case, and it's a simple numbers argument. Some of these huge cloud providers are spending so much that they actually have negative cash flow. And you think, well, that just can't last forever. But then there's the bull case, which is just as strong. The folks building the most advanced AI models are saying they need multiples of the computing power they have now. In fact, just running the AIs they already have, what we call inference, is eating up so much capacity that they can't even build new models as fast as they want to. It's creating this incredible cycle of more and more demand.
And this quote from someone in the industry really just nails that bull case. I mean, think about that. The gap between demand and supply is getting wider every single day. That doesn't sound like a market that's about to slow down.
So where does Morgan Stanley land? Well, they've been doing their homework, making calls and checking in with the supply chain. And what they're hearing on the ground just flies in the face of that cash flow argument. Suppliers are seeing orders for multiple years out. Some customers are even prepaying for parts all the way out to 2028. You just don't do that if you think you're going to slash your budget next year.
All right, so that's the spending debate. What's the other big worry for investors? Well, it's market share. I mean, NVIDIA is the 800-pound gorilla. Can they really hold on to that top spot as all this new competition starts to show up?
And I mean, just look at this. The dominance it's pretty staggering, right? We're talking about an 85% revenue share in these AI chips. The custom-built chips like what Google uses are a distant second, and AMD is currently a very small slice of the pie.
Now here is the key point. The report thinks, maybe NVIDIA's shares slips a little bit. But, and this is a huge but, the entire market is growing so fast, it almost doesn't matter. Their checks show that even the biggest customers who are buying competing chips are still planning to increase their spending with NVIDIA by more than 80% this year. The pie is just getting that much bigger for everyone.
So, how do they defend that massive lead for the long haul? Well, according to the report, the answer is their next major platform, which is codenamed Rubin.
And this is a really critical insight from their research. It's not just NVIDIA loyalists who are watching this. Apparently, every major customer, including the ones making their own chips or buying from AMD, is intensely focused on what NVIDIA does next with Rubin.
And this gets to why NVIDIA's lead is so tough to crack. It's not just about having the fastest piece of silicon. It's the whole package. It's the CUDA software that millions of developers are already trained on. It's the full systems they sell. It's even new technology they're buying up. The thinking is that their big GTC conference that's coming up will really drive this point home and remind everyone just how deep their advantage really is.
So this brings us to the last piece of the puzzle, which is the stock itself. If the business is this strong, why hasn't the stock been moving? Well, it all comes down to valuation. And this is the number that really underpins the whole top pick call, 18. Morgan Stanley estimates that NVIDIA is trading at just 18 times its projected earnings for calendar year 2027. For the company at the dead center of the entire AI build-out, that is a surprisingly low number.
You can really see it here on this chart. This shows NVIDIA's PE ratio, its valuation, compared to the rest of the market. And even though the business has been on an absolute tear, the stock has actually gotten cheaper relative to the S&P 500, not more expensive.
So why is it so cheap? Well, it brings us full circle right back to that skepticism we talked about at the beginning. The market is pricing the stock as if the growth is about to hit a brick wall. And Morgan Stanley's whole point is that this feeling, this sentiment, is at a total low point that just doesn't line up with the reality they're seeing.
But okay, let's be balanced here. No investment is a sure thing, right? The report is very clear about the potential risks to this call, and it's important to keep them in mind. So, what could throw a wrench in the works? Well, a few things. If money gets tight, that spending spree could take a pause. Some brand new revolutionary technology could come out of left field. Rising costs for things like memory could squeeze their profit margins. And, there's always the chance that even if the earnings are great, other investors just decide they don't want to pay more for the stock.
But after weighing all of those risks, the report comes right back to this conclusion. The chance to buy the single most important hardware company in the AI boom, at a time when nobody seems to believe in it, for just 18 times forward earnings, that, to them, feels like a bet with really good odds.
Which really leaves us with this final question to think about. When you have all this evidence pointing to strong growth, a defensible market lead, and a clear plan for the future, is it possible the market is so worried about what might go wrong that it's overlooking what's right in front of its face?